Hey, everybody. Before we get going with this week's market outlook, Chris Barron here to remind you about the AgView Executive Business Conference, which is going to be held January 22nd, 23rd, and 24th. And we have a special surprise for you guys on the 25th, which we'll be announcing right around registration time. With that said, registration is going to open on the 3rd of September. The event is going to be held in Fort Lauderdale, Florida at the Margaritaville Hotel, which is right on Hollywood Beach. So we're excited to have everybody there. Again, we're going to have an outstanding group of educators there that are going to give us a lot of executive business training. We're also going to do a lot of networking. It's going to be an opportunity to meet some of the best producers across the U.S. and Canada. With that said, we're excited to announce that. Again, the dates are January 22nd, 23rd, and 24th for the AgView Executive Business Conference. Can't wait to see you there. Watch for the registration. That opens September 3rd. With that said, enjoy today's podcast. Welcome, everybody, to another episode of the AgView Pitch. We are in the middle of July, the 15th through the 19th, and it is time to talk markets. We've got with us today Jarod Creed. Jarod, how's it going?
It's going good. As always, I appreciate the invitation. Are you ready for a rain yet?
Yeah, we're ready for it to not rain so much all the time, at least in our area.
Okay.
How about you guys?
Oh, I bet we would take another rain here.
Yeah.
I just figured that'd be a good lead off. You know, we're recording this on a Saturday, and never say never. Maybe we are actually going to dodge a bullet. That sounds bad to say, dodge a bullet and not have a weather market this year. I got that all messed up, to be honest with you, Chris. It looks like we actually might have a weather market. How about that? That's a little cleaner. 2-week forecast is still looking a little dry here as of Saturday morning. And, you know, I'm not advocating that that's going to create any type of excitement in the market, but we all know, all your listeners know, when beans are made. And if there's going to be any type of excitement around weather, it seems like it better happen now or never. Especially with the U.S. crop.
Yeah, I think that's true for the beans. Do you think the beans have horsepower enough to move the corn market when we're sitting on a blanket of 23 crop, though? I mean, is it one of these?
To a limited amount. You know, we had a WASDE on Friday the 12th.
Yep.
You're right. Yeah, Friday the 12th. And if anything, you basically loaded that corn balance sheet up with a lot of corn, but not quite as bearish as what it once was. Is that starting a trend? No, I don't think it is. But the main highlights there is that we actually saw our usage go up by 145 million bushel on corn, with the two biggest movers being 75 million bushel increases in both ethanol and exports. I can scratch my head very confidently on the export side on how they're even able to do that. But nonetheless, we got that increase, and that export increase rolled right into the new crop balance sheet as well. So we took another 100 million bushel jump on exports for 24-25 crop year. My point in all of that is maybe a little bit of headline opportunity or risk. The market saw, hey, we're going to end the old crop year under a 2 billion bushel carryout, 1.8 and change. And I suppose, if anything, Chris, it's mentally, it's not quite as scary to be closer to a 2 billion bushel carryout rather than a 3 billion bushel carryout on new crop. And maybe that can be, maybe that can just create a little bit of a situation here that if the bean market does get any excitement, maybe the path of least the resistance on corn is no longer just lower. It certainly doesn't mean that it's going to go higher. Path of least resistance might just mean we're going to stall out for a while, and that really wouldn't surprise me.
Mm-hmm. Yeah, I think, you know, I don't know. I at one point I think there's, you know, maybe the USDA is wrong on how much old crop we're sitting on the corn side of the equation. And then other times when I talk to some people that tell me they're sitting on 100 and some thousand bushel here and there. I've ran across some people. Most of our clients have it pretty well gone, but you know how that is. You get these phone calls and you talk with people and you start like Yeah, there's some stuff out there. The other part of the equation, though, that I'm curious on, and our local elevator, um, uh, one of my partners was having a conversation with them the other day, and typically by the middle part of July, they have in just their co-op, the local one, they usually have about 500,000 bushel of corn of new crops sold for, fall harvest delivery. And on soybeans, they usually have about 175, sometimes, 180 average sold by this time of year. And this year they're sitting with 30,000 bushel of corn sold and 5,000 bushel of beans sold with 3 farmers. In other words, nobody
Yep.
has anything sold on new crop. If we start seeing, it's not only the old crop though that could pressure this, isn't it? I mean, the new crop's gonna obviously going to have to put some pressure to the downside, isn't it? When we start getting some rally, maybe the your second harvest comment that you've had in the past, where the all that that old crop's hitting the market, but isn't there going to be a bunch of new crop at the same time, especially on the soybean side too?
Yeah, we run a risk there. I think I could break that up in 3 buckets. And I want to actually include a real quick comment on fund positioning. A record short and leave it at that. It means nothing more, nothing less. I really am a little fearful that hopefully not your listeners, but I think people are going to try to gravitate towards that attention like, oh, the funds are record short. They got to get out. No, they don't. Not with these carries and not with the big supplies hanging over our head that can let them out. Because if they want to get out, they have to buy, and they can buy it right from the farmer. Step 2 is the wave of this old crop that is still coming in. I fielded a lot of those similar phone calls, Chris, from individuals I've never met before. What do? I still have 50, 75% of last year's crop on farm. I have all my soybeans, or I have all my corn. I sold all my soybeans. I didn't need the money, so on and so on. And that clock is ticking. There's only so many different things they can do. And we talked about the undersold pace that somebody sent me a video of what we recorded out at your place a couple years ago, and it actually was that report that had just came out was the start of farmer selling tipping over, as in running ahead of pace to behind pace. So it's been a 2-year event that the farmer's been undersold, and now it's all coming to a head here that we're so far behind that the amount of selling pressure that can possibly come from the farmer in the next 6 months is the most we've ever seen. And you don't just all of a sudden catch up on selling 5-6 billion bushel in the open market and not have any type of market reaction. And on top of that, the end users can't handle purchasing all that much grain at the same time. So I don't know what's going to shake all that loose. They might be forced to do it. But at the end of the day, yeah, this has been a 2-year cycle that the farmer's running behind normal selling pace. To a certain extent, that's the global farmer, not just the U.S. farmer. And it's going to take some serious soul searching for individuals to actually get back to normal pace, absent of a pretty significant rally in the marketplace.
Mm-hmm. And it's going to take something pretty significant to cause that too, I'm afraid. As far as, you know, thinking about the outside markets and that kind of stuff, like energies and just global, geopolitical stuff, just all kinds of different things that are going on. Is there any one thing or two things that could be a catalyst or help with anything in terms of the upside, or is there just really nothing out there? Because really it's the demand side of the picture that's the issue as much as anything, or the most biggest part of it probably, it sounds like. But is there any other stuff on the outside that you're watching, or is that just a hopeful thought?
I think you could make a pretty decent case that if President Trump is reelected, that the assistance that has been given to Ukraine could abruptly stop. And what does that mean for global grain trade flow in the event Russia is able to escalate things? That's pure speculation, Chris. I would say that that's probably the number one thing on the radar. But after that, you might be able to shift back to the inflation game. You know, CPI this last week showed that we were still running 3% above last year, albeit a little bit less than expectations. And it's just, you're going to have to do some, you're going to have some creative thinking to be able to find what those possible outside catalysts can be that would actually give a lending hand to the grain market. And I just don't know if there's a couple just to pick and choose from right now that are surefire possible assistance to the grain market. It's just not the marketplace we have today. So manage money short, what can force them out? That might be able to help us a little bit in the market, but you got to keep your expectations very realistic. And outside of that, you hit the nail on the head. Our demand picture is still so bleak that it's almost like we need to have the unexpected happen and say, we're going to drop all these tariffs on China. And I think all your listeners know that that's not going to happen. Never say never, but I doubt that's going to happen.
Mm-hmm. One of the last questions I have for you here is around the idea of basis, not only right now, but as we look at new crop and here in the next couple months and things that farmers need to be thinking about as they manage that component. And we've seen such a strong basis in so many areas. And I think mainly it's just because nobody's selling anything. They're willing just to sit on it in the bin. And they've had to like really, in a lot of areas anyway, it's not every area, but in a lot of areas, it seems like the processors just had to be like reaching in and pulling it out of the bin. The farmer's not willing. And so basis has been doing the work. What's your thought? I mean, that door is only so big as we get close to harvest. Is there going to be a basis opportunity, do you think, right in front of harvest on the new crop stuff like some years there is, or is that when all the old crop stuff's going to be trying to get through that door at the same time? Any comments on that?
Logical thinking would say that the old crop trying to get through the door is going to roadblock any premium opportunities on the front end of harvest. But I don't think that it's that simple. There will be regional opportunities dependent on the setup of various processors, areas that can actually dry corn, maybe some areas that are shorter corn around, your bird markets, Eastern Corn Belt, far Eastern Corn Belt. I would imagine is very likely to see some early harvest opportunities to move feed into the bird market. When you get into the ethanol market, I think it's just going to kind of be seasonal. There will be some opportunities that pop up, but I imagine they're going to be pretty short-lived. I mean, what have we seen the last 3 years? That when that inverse goes into harvest, it goes fast and it turns ugly pretty darn quick. So that's probably probably about as good a time as anything right now, Chris, to start looking at, okay, what do I have coming out of the field, especially on corn? What am I going to be able to bring in at this point in the last half of September, first 10 days of October? What type of drying programs or shrink or basis, what have you, whatever creates a premium for a week or two delivery window versus the week or two after. Probably got to start having those discovery conversations now. The problem is most of those buyers might not even be interested in discussing that because they're just focused on hand to mouth to get to new crop supply.
Mm-hmm. Yeah, there's going to be a lot of things, and it's going to, like you said, it's going to be a regional algebra problem for a lot of us to do with the components you just talked about. I think that's something that the reason I wanted to ask that is because I think that's something that we all need to be kind of dialing in now and having those conversations with whoever our customers are, where our grain's going and having those conversations earlier rather than later.
You bring up a good point there too, that one of the things we probably need to acknowledge is that 10, 15 cent premium opportunities versus gut slot harvest. That's maybe a reasonable expectation versus 30 to 40 cent premiums last year and maybe as much as 75 cent premiums a year prior. And that's just a sign of the balance sheet and farmer-owned grain being much different than it's been the last couple of years. So there'll still be some premium opportunities. They're just not going to be, they're probably not going to be quite as lucrative or attractive as what we've seen the last couple of years. With that said, 10, 15 cents, just 200, 220 bushel corn, what have you, that can be the difference between, moving the needle to an above a break even to below a break even. Well, especially if any grain is already hedged or have HTAs with those facilities, you just got to push the pencil and jump on whatever opportunity does come.
That leads me to the last part of the conversation I want to have with you, Jarod, which is around analyzing your risk management plan that you have in conjunction with the marketing. A lot of our clients have ECO. Some have margin protection. I know yours pretty much all do on the margin protection side. We've just, we don't work with them directly on the risk mitigation, but there's a lot of ECO. There's a significant amount of 85%, especially in those areas where the APH levels are good and where they can, kind of justify that price. When we look at that, let's say, for example, we'll use corn as an example, and, you've been dealing with wheat lately, and you look at, as we get into corn harvest, and it's not that far away in the South. I know Texas is already about done. When you look at that harvest, when things are coming in, and you can start estimating at this point and say, okay, if that October price does get and dips down below, say, that 390, 96 or 97 area, right in there is where, if you yield your APH just on the 85% RP plan, you're going to be in the money. And I think it's 981 on soybeans from what I'm seeing with our clients at APH yield levels. I like to see people running those numbers and figuring out on a per bushel basis, what does that potentially mean to your price? So if you've got an indemnity payment of 40 cents a bushel on corn coming because you're in one of those super wet areas or whatever, having that in your mind and on the marketing page so that you see what your actual number is with those two combined. Any comments on that? Things that people should be thinking about as they look at their risk management plan as it correlates with marketing?
Yeah, so to make that process easier for everybody, I like to tell them that you need to break out 4 buckets. First bucket is whatever sold bushel and acre you have at whatever that average price is. That's very easy. Multiply those two together, you have a certain amount of revenue per acre. The second bucket is the rest of your crop that you do not have sold at today's market price. Multiply those two together. The third bucket would be doing a calculation on insurance. We'll come back to that in just a second. And the fourth bucket would be anything else. Are you getting government programs? Are you getting, in a carbon space, what have you, any other dollars that are coming to the table that need to be acknowledged? On the insurance space, you hit the nail on the head. Multi-peril, 85% policies. With the crop that's in the field today, I feel relatively confident, at least in corn, that the majority are probably not looking at much of an opportunity in the here and now to be generating anything from crop insurance. Now, you take another 20, 30 cent setback, then that changes. On the ECO side, or any of your 95% programs, all of those are requiring an above APH yield as of today. So with December corn futures being right around 415, and if you're carrying ECO, the trigger event is currently about I'll call it 106, 107% of APH yield. That would be on your own farm. But the other side of it is ECO, margin, those are county-based, meaning the county has to yield at least 106, 107% of their expected county yield. So for simplicities, if you're in a county that expects a 200 bushel yield, at today's futures price, it requires a 213 to 214 bushel yield. So that third bucket of calculating what that insurance is, that is a liquid situation. If the market goes higher, the insurance probabilities go down, but you're picking up revenue in that second bucket on the unsold grain. Flip that on its head. Market goes lower, you're losing money on your physical grain that is not sold, but you're possibly picking up more money than what you're losing from your insurance product, especially if markets would go down to a price point that more or less creates a yield requirement that is not realistic. And that can certainly happen. I mean, you back this thing up to, let's just say $3.80. We'll do simple math here. I'm a 200 bushel county. I'm going to insure that at 0.95, 95%. I'm going to take that times the insurance price of $466. That's an $885 an acre revenue trigger. And I divide that by 380 December corn, if that would happen to happen. Now you're requiring a 233 bushel yield, which is basically 116% of the expected. You might find situations that threshold cannot be met. So then it comes down to a little bit of deeper management. Here's the one thing, I've probably said this before. When you buy an option, you don't just buy it and forget about it. You have to check in on it. You have to manage it. And a lot of your insurance products are very similar to an option. You buy it, you still have to check in on it, and you have to understand what your possible next steps are for risk mitigation between every single day and the actual expiration of that insurance product. Because if we were at 380 December corn today, Chris, and a producer had an 85% policy and was carrying ECO, I would actually make the argument that if they had a decent amount of new crop corn sold, their financial risk is that the market goes higher in the short term, not lower, because they're generating more revenue from the sales and insurance than what they are with the market going higher. So it's something that has to be managed appropriately, and there's a lot of different ways to do that. It's just making sure that you're valuing those buckets all together.
Yeah, and that's where, I'm not sure that there's an absolute tool out there. You've got a way to analyze that's pretty interesting. And in our operation, we've essentially put every field in. We always buy optional units, and so we've got every individual unit in there, so we can change a couple of those variables, and we can instantaneously see where we're at. And I think that's the encouragement I want to give people is actually spend some office time and get your data in front of you, however you've purchased the insurance, and then have your insurance agent, so they're worth their salt, are there looking at that with you and making sure you've got your numbers in there right, and that you're really looking at that. Because the ones that I'm seeing that are doing that and analyzing that have done a way better job of marketing and way better job of capturing the profitability. So I appreciate you talking through that, because I think those are just some things that it's, you can sit in the office and do something like that and probably make yourself $1,000 an hour, even though it's more fun to be out in the shop wrenching on something once in a while, or mowing the lawn or whatever. Some time spent doing those calculations now, I think, is one of the best pieces of advice we could give, for sure.
I don't know what the next couple months of the market holds, but I don't necessarily think we're completely out of the woods from the possibility of grains going lower. So I would still think that the 1, 2, 3-step process here, and I'm willing to help out all your listeners here, Chris. First step is they need to get their schedule of insurance from their insurance agent. Literally, schedule of insurance. That is your document that's going to be basically the revenue guarantee Bible for your farm. Whether you're optional, you're enterprise, you're carrying add-on products, what your individual APHs are, so on and so on and so on. Step 2 needs to be something that I think I'll create something very, very simple, Chris, little cheat spreadsheet for any of these individuals that have ECO to be able to plug in, and SEO for that matter, plug in their APH, their county yields, and just be able to update the market price associated with what they do and don't have sold. And I like to call it a bell curve. It's going to tell you your absolute worst case situation based upon yield forecasts and whatever that price would be to show you worst case. Hopefully that worst case is still a profit, but you can see that market goes much higher, things get better. Market goes lower, things get better. How do you start to extract that last 3, 4, 5, 6% of revenue out of the middle? And that's not chump change when you're talking about $800, $900, $1,000 an acre revenue. There's definitely possibilities of extracting 50, 60, 70 bucks an acre from your insurance product you already spent money on to maximize your purchase. We do that on all pieces of equipment that we buy typically. I know the value that I'm supposed to get out of it. I don't buy it just to have it. And that's the same type of thing with insurance. And then the last piece is making sure you understand the tools that every farm has access to mitigate that risk, to mitigate the risk that you have. And risk is both good and bad. Right. So I will Monday, I'll have a spreadsheet in your email that if any of your listeners are wanting that, just have them ping you and we can get it over to them.
Okay. That sounds good. Yeah. I think just having that, like I said, something like that. And then a lot of people can build out if there's some other angles or some other things they're doing they want to look at or other systems they already have and do some comparisons. So I appreciate that. That's really generous. And I think that's just the point here. And why I wanted to have this part of the conversation towards the end here is just how important a year like this is going to be. Because I think it's, this would have been a year people thought there was going to be no insurance indemnities paid out. And because of weather and because of price decline again, like last year, we're back in that boat again where we need to kind of be navigating this stuff. So appreciate that. Any final comments, anything you want to leave the listeners with as they look at a couple of weeks?
I think a very important one, Chris. Knock on wood again, this isn't any of your listeners, but actively right now in the last week or two, things have gotten rough enough out in the countryside that there are loans being called from banks, with a full crop out in the field, individuals that it's just mathematically impossible to dig out of a hole that the bank cannot, quote unquote, afford to loan into anymore. Massive working capital reductions expected. Some of your big banks are actively educating their loan officers and their risk department and their underwriters exactly how they intend on handling distressed balance sheets. That leads me all to a piece that, Pete Meyer and I were talking here earlier this week. What's the number one most important thing for a producer that is possibly behind the 8 ball right now when it comes to marketing and looking down the barrel of some negative margins? Do not let it get worse. Do not let it get worse. And you need to be liquid when you're dealing with the bank this winter. And what I mean by liquid is that doesn't mean sitting on copious amounts of production in the bins or in the elevator. Turn it into cash. And if you desire a spot in the market for a longer haul, that's great. There are less risk adverse tools to use and a defined amount of risk. But it seems like the last couple years of conversations and risk is coming to a head that there will be a lot of operations that will not be operating next year. Mark my word. And I think it's interesting that just this last week alone, these are all land purchases. We had 6 different land deals go down Monday through Friday this past week. All purchases from people either being forced out or just wanting to liquidate and stop farming. So it's happening. That was quite the wake-up call this last week of how fast that's happening though.
It's interesting. I think that's a topic we need to do on 19 Minutes on our subscriber podcast because I've heard a little bit of rumblings of the same thing, but we have this little skewed world we live in because the people that are reaching out to us are actually still quite good in working capital. But the good part of that is this is the opportunity that's going to come their way for growth.
Exactly.
Yep.
It's forecasting what do I need to do to jump on those opportunities for the next year or two.
Right.
There's good and bad things that come out of that conversation. The good thing for hopefully most of the listeners is that this isn't a pat on our back, Chris, in any way, shape, or form. But generally speaking, if the message in the last couple of years and the due diligence took place, there should be lots of building opportunities for these operations to do what they want to do here in the future.
Mm-hmm.
And that's arguably a repeat of what happened from 14 to 19. Individuals that kept making money was able to grow the farm in a correct manner, business correct manner, and all of a sudden you have the big boom, and that's where the real money was made. Tighter margins for several years, and then all of a sudden big triple-digit margins for a few years across more acres. That's where all the real money came from. And make no mistake about it, I think that's going to happen again.
Mm-hmm. Yeah, for sure. I think usually challenges and issues create opportunities, and I think there's going to be some big opportunities for some people, and unfortunately not a very good situation for some others. So, but life goes on, and welcome to the ebb and flow of agricultural business. So it's
yeah, for sure.
It's cyclical. It always is, always has been, and always will be. So, hey, Jarod, this has been a great conversation as usual. We'll obviously have you back as we continue to chew through the latter part of the growing season and start looking at fall harvest, and we'll get you back again. And I think we do need to get connected and do a 19 minutes. For those that don't listen to 19 minutes, they come out on the 9th, the 19th, and the 29th, and they're always timeless business topics on action items and things that you can do to improve your business from an executive level mindset. So with that said, Jarod, thanks a lot. Really appreciate your time today.
Thanks, Chris.
Yep, you bet. And thanks everybody for listening, and we will catch you again next time on the AgView Pitch.